Good morning, everyone. I am CA Shruti Gupta, and I welcome you all to the Valuation Manthan session, Series 41, ICAI Valuation Standards versus Valuation Standards, International Valuation Standards, organized by the Valuation Standard Board of ICAI. We are delighted to welcome you all to an empowering journey through valuation expertise. So, without any delay, I would like to welcome the speaker for the day who will be deliberating on the topic ICAI valuation standards versus international valuation standards. CA Deepam Patel, he's a partner at Kantilal Patel and Company and is a chartered accountant, a company secretary, LLB graduate, and a registered valuer. He's an expert in the field of valuation of securities and financial assets, and he's also the first CA from the state of Gujarat to clear the examination on valuation for registration as registered valuer in September 2018. Deepam ji is a regular and prime contributor in various newsletters and publications. His comparative study of revised Schedule 6 and the erstwhile Schedule 6 was also included in the guidance note of the revised Schedule 6 by ICAI. He is an eminent speaker and has shared his wisdom on various topics, including valuation, changes made by the Union Budget, Companies Act 2013, income computation and disclosure standards, goods and service tax, international taxation, and many more. Thank you so much, Deepam ji, for gracing us with your presence. We are sure that with such vast experience and knowledge as yours, we are going to learn immensely from you in next 2 hours. Thank you so much, sir. We are eager to learn from you. Over to you, sir.
Thank you, Shruti, for the introduction, and a very good morning to everyone. So I'll start the session. I'll first share my screen and we'll confirm. Yeah. So is the screen visible?
Yes, sir.
Hello, good morning, everyone. Am I audible?
Yes,
Yes.
ma'am, you're audible.
Deepam bhai, am I audible?
Yes, ma'am.
Yeah, so I'll like this opportunity to welcome all of you. If you can stop sharing,
Yes, ma'am.
really
I'll
helps.
stop sharing. Yeah.
Yeah. So welcome all of you to this valuation. We are disseminating the knowledge on valuation. So I am happy that this Sunday Deepam bhai has joined. So this is a 41 series, and welcome all of you. And we have received very good response on this. And friends, the ICA valuation standard is the only standard which is available in India. However, other bodies actually have only international valuation standards which they follow. So a lot of efforts have been put by IBPI, ICAI, Triple IPI for having these standards, and ICI is actually doing a lot of hard work for the same because there is a few changes and differences in both the standards, which Deepam bhai will take us the journey through. But being the Indian culture and what the valuations require, accordingly, these standards have been made. So it's always better to have our own standards, and it is mandatory for our members to follow the same. And for that, this session has been put. What are the differences? And this will be really helpful. I wish a happy new year to all of you, and this year bring prosperous. And I wish that all of participants reach to the highest pinnacle in the professional career and happiness in the family. With these words, I welcome all of you, and thanks the speaker in this series. So thank you so much and welcome all of you. Over to Shruti.
Thank you so much, ma'am, for sharing the words of wisdom. It was really enriching for us to know about the Valuation Standard Board and the initiatives taken by ICAI. So, without any delay, I would again pass on the stage to Deepam, sir. Please, sir, share your experience with us and enlighten us. Thank you.
Um, Yes, so good morning. Today, what we'll be discussing as an agenda would be international valuation standards and ICI valuation standards. We'll be comparing them slightly, and we'll also be learning across the journey of these the discussion. So, at the outset, first I would like to express my gratitude for all of you joining us and today sharing your time with us. I'll try and deliver the maximum value for your time. And that's the mantra that I follow. Whenever, you give me time, I should exchange it for value. The first thing that I wanted to just set the context. We'll first discuss about some background. Then we'll discuss about RVOs, why valuation standards were introduced. Is valuation art or science? Because once you standardize things, the idea is that there's a set procedure to be followed, and that would give you an end result. So that makes it more inclined towards science, and whether valuation is an art or a science, age-long question. We'll deliberate a bit on it. Then we'll discuss about the Indian valuation standards issued by the ICI, then the international valuation standards, and we'll compare them. And then at the end, we'll have the question and answer. So the background that I wanted to discuss right now is to set the context of standards per se. What are standards? What are valuation standards? What are business standards? And what happens and what is a standard? So, as the audience, we all are chartered accountants and we understand financial reporting as a core area of practice, right? So, the first thing that I wanted to set context with is financial reporting standards. Now, if we as chartered accountants understand how we have been helping businesses with, auditing their books of account, auditing their financial statements. The idea is that we follow a financial reporting framework. Now, that financial reporting framework is known as accounting standards, and those accounting standards vary across the globe. So, even in India, as we all are aware, there are two sets of accounting standards, one which is known as Ind AS, which is Indian Accounting Standards, and one which is known as accounting standards, which are IGAP. So one under the company's Indian Accounting Standard rules, and the one which is the earlier one. Now we understand that in India, a certain set of companies which meet a certain threshold have to follow Ind AS, and for the rest of them, IGAP is applicable. Now, if we were to look at this, we understand that these are accounting standards, and these are basically a set of standards that govern how a financial statement should be prepared. And that's what sets the context. That standards are basically giving you a guiding force that this is how you have to proceed in this. When we compare Indian standards with global standards, even for financial reporting, we have Ind AS, we have IGAP, and then we have IFRS, which is kind of the international financial reporting standards, and they are very much similar to Ind AS. And as we know, Ind AS is a carve out from IFRS, and that's how we know that these two standards exist. So there's an international financial reporting standard, which is IFRS. Now, nomenclature here plays a very important role. When we look at IFRS, we refer it to International Financial Reporting Standards. If we were to understand the context, what are IFRS, who issues it, who follows it, then when we dive deep into it, we understand that there's an international AASB which is there, and there's a IFRIC committee, and all of those are there, which kind of have a nomenclature which gives them the background of it being international, which is International Financial Reporting Standards. But as we are aware, a country like India has not adopted IFRS per se. IFRS, we have carved out for it to become Ind AS, and we have adopted Ind AS. So that's where international financial reporting standards or international valuation standards, they kind of have that nomenclature advantage for them being international. However, that does not make them what applies globally. The overall context of having a very similar financial reporting standard or a very similar valuation standards across the globe makes it easy for economies to become global. So, for example, if tomorrow a global investor, a person from, say, France, wanted to read a financial statement of an Indian company with the objective of investing in that company, if IGAP would have been followed by the Indian company, it would be very difficult for the French national or the French literate guy to understand that what is and how is the financial statements prepared, because the basis of preparation is slightly different. So that's where a common platform, a common standard comes into picture, that across the globe, if there is a very similar approach to preparing financial statements, the readability of those financial statements increase. Similarly, if the approach of valuing assets is very similar across the horizon, then it gives a very good context of us getting into a situation where we can compare valuation standards across the globe. If you were to look at financial reporting standards, we have Ind AS, IFRS, IGAP, which are what we kind of know. And then there are various other countries which have adopted their own accounting principles, which is US GAAP, Australian GAAP, Canadian GAAP. Largely, they are carve-outs from IFRS, but yeah, they are slightly different, and those differences have to be appreciated while we have to look at that specific economy. And that's where valuation standards also, we look at various standards across the world, and that those differences come into picture. Now, the second thing that I wanted to talk about was something that is business standards. If we were to look at businesses, right, they also strive to get some or the other recognition. For example, we as professionals understand that financial reporting has standards, valuation reporting has standards. They are kind of regulated, and there's a purpose behind it. That this is how standard setting works for, kind of regularizing common presentation, a standard approach. That is what we understand as professionals. But even for businesses, there are various standards, right? The standards that apply, for example, one is ISO, there's IEC, then there's JIN by the Japanese Industrial Standards for Textile Engineering, then there's BIS PGD, so that's Production and General Engineering Standards. And what I would say is that why are these standards? So one objective of standards, we understood that standards typically help in setting a commonality for various purposes. For example, it's somewhere it is like for financial reporting or for valuation, as we understood. But standards in business, there's HSN, which is a classification system. So if we were to look at just the composition bit of it, composition wise, we would understand that there's a lot of commonality across the HSN system. That if you classify something as uric acid, then there's a chemical composition to it, and that's what would make it uric acid. But what are standards? In business, if we were to understand these standards, they are essentially benchmarks for quality, and that's benchmark for the process that they follow. So if we were to look at ISO standards, they would kind of work in a manner where the business that takes the ISO standard gets into a zone where they have a process that they follow. And with that benchmarking, they establish that the products that they manufacture or the products that they deliver to the customers have a set level of value. So, if we were to look at standards in business where there's no regulatory requirement for essentially complying it with it, the objective there becomes quality. So in our profession also, the dual objective of standards is not just commonality across the globe, it also is to enhance the quality of our profession and the quality of the deliverables that come out of our work. Now, these two things that come together, they are essentially what drives a profession. The commonality, the prescribed framework, and the quality that you deliver in your services. These two are the essential driving force of a profession. And if you were to look at more frameworks, right, before we dive into valuation standards, the recent buzz is all about ESG, right? Every organization is talking about ESG. Professionals are talking about ESG. The world as a whole is talking about ESG and how it should be integrated into business processes. Even for ESG, if you were to look at, there are various standards and there are various, the organizations that are leading the way for even businesses for reporting purposes. So there's GRI and there's IRI. I remember integrated reporting is one part of it. There's a separate organization also giving out standards for integrated reporting, and there's also GRI, which is the Global Reporting Initiative, which is giving out its own standards. Then there's ESG, which is as a concept. Then there's ESRS, which is European Sustainability Reporting Standards. Then there's the Sustainability and Accounting Standards Board. Then there's GRESB, there's UN SDGs. So these are all standards and these are all frameworks that are available for businesses to work with and work on a platform where at least there's some measurement of their performance, there's some standardization, and with those two objectives, generally all standards and frameworks are prepared. So this was just to set the context of what standards are and why valuation standards kind of are important for us to understand and work as professionals. With this, I'll dive slightly into the background of ICAI and the valuation standards which have been issued by the ICAI and what is the ICAI RVO. And valuation per se, what is valuation, right? So valuation per se, if we were to ask a layman, they would say that what is the transaction value of a particular asset would be what a valuer would give. For example, it would say that you have to estimate the market value of a financial asset or a liability. And that's what the objective of or the end result of valuation would be. And what was the overall background for valuation standards to come into being? The first thing that I would say is that earlier, a lot of valuation professionals were following different methodologies and approaches to value asset and liabilities. And that's where, as we understood the two objectives, standardization and quality, for the purpose of bringing in standardization, valuation standards were recommended and put into practice. So, if we were to look at this objective, the idea that led to the creation of valuation standards and the entire process that led to the creation of the entire profession of registered valuers. We'll discuss it in the slide when we discuss about IBBI and its role in the entire valuation profession. But largely, if you were to understand that standardization and quality, these were the two large objectives that any standard setting brings to fore. So if we look at the vision with which the ICAI valuation standards were issued, the statement that comes out in the valuation standard itself is that ICAI issued valuation standards to set up procedures, principles, and concepts. So procedures are basically those things that a valuer has to follow in the entire process of valuation. So if we were to take it from the start of the engagement, which is from deciding the scope of the engagement to agreeing the scope of the engagement letter, analysis, reporting, conclusion, reporting, all of that, the entire procedure that has to be followed by the valuer in the process of valuation has been brought in by the ICAI valuation standards. Then there are principles. Those principles essentially are the the understanding of the entire process of valuation, understanding of entire concept of valuation, and understanding how you would apply a particular approach or a particular method to valuing an asset. So that becomes the second objective of bringing in the valuation standards. And the third was about the valuation concepts, which is how do you go about valuing an asset? Whether if it's a going concern valuation, what would be your approach? If it's a liquidation valuation, what would be your approach? So all of that kind of works coherently and giving in these three primary objectives, which is procedures, principles, and concepts for the valuers for understanding, for implementing. So that becomes the primary objective. And what valuation standards issued by the ICI also seek to achieve is to make these procedures, principles, and concepts which are generally accepted internationally and for the legal framework and practices prevalent in India. So, the modification of those internationally accepted valuation principles was to bring it into what is also acceptable as a legal framework and practices prevalent in India. So, as we understood that the entire concept of Indianizing the valuation standards was something that was the overall objective with which the ICI Valuation Standards Board came out with the valuation standards. And that's where it makes ICI valuation standards slightly more unique in the Indian context. Now, if we were to look at what are the achievements of valuation standards, right? So the ICI valuation standards, when they have come into implementation, the overall objective with which it was coming into implementation and the achievements that it was aiming at. And I would say that largely because of valuation professionals starting to understand ICI valuation standards, because there is a valuation standard in practice, in force right now. The objectives which it was set to achieve have already been there, and they have kind of been on the path of achieving it. Largely it's always a process of continuous improvement. But yes, if we were to look at our valuation profession just before the implementation of valuation standards and after, the speed of change is rapid. So if we were to first look at uniformity as a achievement, if we look at how valuers were valuing financial assets before ICI valuation standards and how they have been valuing financial assets after the valuation standards, there's a very vast difference, primarily because procedures are being followed. So there's a uniformity in the approach to valuation. Secondly, principles are also written in the valuation standard. So now there is no subjectivity left in, one person valuing and the other person valuing. There's not much of a subjective difference. There always is a slight, we'll come to it when we discuss art versus science. But largely what we understand is that this uniformity, that approach, that principles that have been brought in by the ICI valuation standards help us in bringing uniformity in all the valuation analysis that Indian registered valuers perform using the ICI valuation standards. The second is about quality. Now, with good standards, the ICI valuation standard sets the base for valuation professionals to build on. So, with good quality of those valuation standards and a very good understanding by the people who have become registered valuers of the valuation standards, the quality has enhanced significantly. And that enhanced quality helps in overall, the quality of valuation across the economy. And with that enhanced quality, the trust of all the stakeholders into the valuation professionals, into businesses that go for valuation has also increased. Third is transparency. If we were to look at valuation standards, they also mandate certain disclosures in the valuation report. So those standards come out with the disclosure requirements also. Nonetheless, I'll just cite an example from past. I've been practicing valuation for over 10 years. And if we were to look at, I'll just cite publicly available information. If we were to look at, say, 10 years back, there were always schemes of arrangement being entered into between listed companies. And historically, those reports, those schemes would always require a valuation report from a valuation professional. And largely back then, there was no registered valuer. So experienced professionals like chartered accountants who would provide valuation services, they would kind of be in that uh, service provider zone, and they would give the valuation reports to these listed entities. Now, 10 years back, if you were to bring a valuation report from the exchange disclosure from any of the listed entities, we would understand that a lot of opaqueness was there in the valuation report. So you'll have 10 pages of a valuation report, 9 pages would be disclaimers and limitations, and the 10th page would give out an exchange ratio. And the basis of arriving at the exchange ratio would all be just textual. It will never have any figurative information, nor would a reader understand how did the valuation professional come to this figure. So, which approach was applied, which method was applied. The report would contain all of those disclosures that I have considered so many, but what I have applied is not necessarily mentioned in the valuation report. I'm not saying it was the general trend, but you would find a lot of opaque reports back in the day. And those reports would then not have a clarity of how and what would be brought and what was considered by the valuer in giving the exchange ratio. However, that has changed with the implementation of the valuation standards. Also, I would say there has also been a lot of regulatory oversight on this aspect. So even after the valuation standards were implemented, many valuers would give out reports with limited transparency, kind of just complying with the standards, where regulatory oversight also came into picture. The stock exchanges and the uh, SEBI, they also came into picture and kind of, mentioned that companies had to get the valuer to certify or give an addendum to their valuation report, giving the entire working of their valuation, including the key assumptions, which approach has been considered, what was the finding of the approach, what was the method that was considered, what was the value that was arrived in the method, and all of those, and if there are weights applied and what was the weight applied. All of those disclosures have now become kind of necessary when you are doing valuation, and that has enhanced the transparency in the process of valuation. Consistency has been enhanced. I would say that earlier, uh, if a valuer would value a particular asset, it may not be necessary for that the next time they may value, they would follow the same approach or the method, or even for a similar asset, they would follow the same approach or method. So consistency as a whole has increased on account of valuation standards. And then there have been valuation policies, which essentially are those which have been guided by the standards, and that comes into implementation for the overall profession. Now, I'll just slightly digress over here about standards again. If we were to look at the achievements of the valuation standards, we understand that uniformity, quality, transparency, consistency, and valuation policies, these are what it has set to achieve, and it has kind of reasonably achieved well. Now, if we were to look at a simplistic explanation to valuation standards, we would understand that any person would, if he follows, the valuation principles, the valuation standards that are there, then they would kind of be at the same level with every other professional. So why are there in profession, certain stalwarts? I say that when we also look at the profession, we look at certain professionals as a stalwart and certain professionals as professionals. Now, valuation standards, or as a matter of fact, accounting standards, auditing standards, they are all available to everyone, and everyone has the same access. Now, still, some people make more out of it, some people make reasonably good out of it. So, why that difference? Why are certain people stalwarts and certain not? So, I just came across a very a good, I would say, it's an interesting term that I referred to today morning when I was reading an article where they were referring to architects, and they referred them to starchitects, which means that certain architects are like you know a cut above the others, and they would be called architects. So I think in chartered accountants also there are certain chartered accountants who have cut above the others, and they are kind of referred to as starched accountants. And that's where I just wanted to pitch in that valuation standards give a base, give a platform to everyone equally. That is, this is what is the bare minimum that you have to comply with, and this is how, as valuation professionals, you need to comply with the standards. But what you go on to build on top of those valuation standards is something that is your own. Now, if I were to give an example, today you understand that the valuation standards would give you the basis, it would give you the approach that you need to follow, it would give you the methods that are commonly applied. But at the same time, if your approach to considering a asset that is being valued, if you do not look at a holistic picture, if you only look at the standards and if you do not look beyond the standards, if you can't improve the quality beyond what the standards require. So this is, you have to understand that valuation standards, as vast as they may seem, they kind of set the minimum benchmark that needs to be achieved, and then you have to build on top of it. Similarly is the case with auditing standards. They are the minimum benchmark that a professional has to achieve, and every professional can build on top of it. Similar with accounting standards. But yeah, accounting standards are kind of something that's uh, more standard in approach, whereas valuation standards or auditing standards are something that involves a lot of professional judgment in application. And that's what makes all the difference. So just wanted to take this anecdote for a bit and I'll continue with my presentation. So if we were to look at the hierarchy of the valuation profession right now, it's kind of IBBI regulates it. And then there are various registered valuers organizations, and then there are registered valuers that come under it. And registered valuers, they are registered with a RVO, and they have to get the training done and get registration. And after the examination, they become registered valuers. Now, if we were to look at the overall context or the overall background of why valuation standards were required or why even regulation of the profession was required, the the underlying crux of it, if we were to look at the historic background, was the you know disalignment or the misalignment of valuation professions in valuing uh, physical assets. If we were to look at the banking system, a lot of loans or the lot of credit was being provided on the basis of security against tangible assets. So in the past, what would happen is that if I wanted a loan, I would go to a bank and they would say that, okay, you want loan for X purpose. What is the security that you're going to offer? And then I would have some old piece of immobile property or whatever in my asset bank, and I would kind of mortgage it with the bank. Now the bank would say, okay, I would have bought it 30, 40 years back, so that value would be very low on the paper, but the value would have appreciated. And I would say that you need to kind of get a valuation done to actually appreciate the real value of the property today. So the bank empaneled valuer would go and do the valuation, and then there would be a value estimate, and I would be given credit on that basis. And after a certain period of time, for example, if my credit goes bad, I can't repay the loan, and then the bank has to enforce security and kind of liquidate the mortgaged asset. At that time they would realize that they relied on a valuation report that overvalued the property, so the banks were not able to realize this. Increasingly, it was only for physical assets. However, lately, even financial assets started becoming the property of mortgage. And that background led to the need of having a valuation standard or a registered valuer profession as a whole, because the idea was to standardize. Regulatory pressure was that this way the financial system cannot kind of go on and have all these surprise findings at one point in time and then repent that, okay, this was how things happened and this is how we kind of lost money. So in that process, the entire profession of valuation came to be, and that's how the registered valuers came into existence, and the entire profession started becoming regulated. And that's where standards come into picture. So if we look at right now, the language of the statute, we'll come to the various provisions within which standards have to be applied. But largely, if we were to look at the concept under law, under the Companies Act also, is that there will be an Indian valuation standards sometime whenever that comes into being. Till then, the only Indian standards, as ma'am rightly explained, are the ICI valuation standards, and they have been the guiding light for the entire country. And that's something that we as chartered accountants should be proud of. That the Valuation Standards Board did this mammoth task of creating valuation standards for the profession. Now, as we understood, there are various RVOs. 15 of them are active. I think it's something just for information. Now, let's look at the end use of valuation standards and where are those valuation standards required for application in our profession. So, if we as chartered accountants practice valuation, what are the end use of valuation standards? What is the places, what are the applications where we would use valuation standards? So, the first end use of valuation standards becomes financial reporting. Under financial reporting, there are share valuation for goodwill and asset impairment testing under Ind AS 36. So largely what happens is that if a Ind AS company acquires a business and that business is acquired by paying more than what the net assets that are obtained on the transaction, largely that transaction, when it is accounted for under business combinations, would result into creation of goodwill in the books of the acquirer. Now, at a reporting date, what happens is that the accounting standards that apply to the acquirer require impairment testing of this goodwill because the assumption with which the business was purchased was that it would generate future cash flows, which would be over and above what net assets it is currently possessing, and that's where goodwill recognition comes into picture. And at each reporting date, this goodwill needs to be tested for impairment. So while you test goodwill for impairment as a valuer, your objective also becomes that you need to follow the valuation standards and you need to give a opinion on whether goodwill, which is carried in the financial statements of the acquirer, does it warrant any impairment or is it good to carry? Second is about ESOP valuation. So if under fair value accounting, so as we discussed, right, under financial reporting, there are two standards applicable in India. One is Ind AS, one is IGAP. Under IGAP, you have both options, fair value accounting of employee stock options, and then under IGAP, you also have the intrinsic value of accounting for employee stock options. So under fair value accounting under IGAP or accounting under Ind AS, both of them require you to have a fair value of employee stock options at the reporting date, and the fair value of those employee stock options at the reporting date is something that comes into valuer's domain. There are two option pricing models that are discussed in the valuation standards, which is the Black and Scholes option pricing model and the binomial model. And these both models are something that find place in the valuation standards. And those methods would also be applied for valuing employee stock options, and that would be for the purpose of financial reporting. And then there is intangible asset valuation for business combinations under Ind AS 103. So if we look at again business combination under Ind AS 103, when there is an acquisition by a particular company of another business, it would necessarily require the acquiring company to do a purchase price allocation for the purchase consideration that it would give over and above the net assets that it acquires. So when you have to do a purchase price allocation, you would essentially follow the valuation standards. Now, as I just mentioned in the previous discussion, that valuation standards create a base for valuations to create value professionals to create on. So valuation standards would give you a base as to how the valuation exercise should progress. Now, as value professionals, it is our value addition or our knowledge and learning that brings us to the place where we are capable of performing a purchase price allocation exercise. Now that's your learning, that's something that you build on top of valuation standards, but essentially that's something that would also require you to comply with valuation standards, and that's how you would apply valuation standards in getting this use of valuation standards. Second is something which is strategic decision making. Some of it is regulatory in nature, some of it is advisory in nature. One of which would be restructuring valuation advice for mergers, demergers, and spin-offs. So under the Companies Act, you necessarily require a registered valuers report for performing any scheme of arrangement, including that of merger or demerger. And otherwise, when you also have an opportunity as a valuer to advise on the potential value of a particular asset. If a company is not in the process of exploring anything, but as a value professional, you identify that in demerging a particular unit, there's a better value creation opportunity, and you demonstrate that to a business, then they find value in that proposition, and that's where advisory valuation comes into picture. Largely, there are compliance valuation and advisory valuation. Compliance valuation would necessarily require some or the other statute to mandate the requirement of valuation, whereas advisory valuation would be some in the nature of completely, there's no regulatory requirement of that particular manner, aspect or item, but you as value professional bring that expertise on the table and give that advice to the business. And that's where creating value out of profession comes into picture. You create value for the client, and in turn you grow as a professional. The second area where valuation can come into picture is legal dispute, or tax issues or valuation of claims or fairness opinions. That's somewhere where valuation standards would come into picture. And then there would be strategic value analysis for fund mobilization. For example, if a business wants to raise capital, then is it the right time? What is the value at which they would be able to raise? They all businesses have these questions before they kind of get into that entire exercise. So bringing those strategic value analysis also would require you to use the valuation standards. And the third one where you would use the valuation standards would be regulatory requirements. So one of the regulatory requirements is under Rule 18 of Companies Registered Valuers and Valuation Rules, where any valuation required under the Companies Act would necessarily require a registered valuer. Plus, here there's an interesting anecdote, right? Under the Companies Act, the purpose of having the entire valuation profession as registered valuers, having the entire item as the concept of a registered valuer, necessarily requires the registered valuer to comply with Indian valuation standards as may be notified, or till the time Indian valuation standards are not there, the flowchart diverges into two. One, which is your existing, if you are a member of an RVO and that RVO has adopted any valuation standards, till that time you will follow those valuation standards. And if you are a member of an RVO which has not adopted any valuation standards, you will follow internationally accepted valuation standards. Now, if we were to look at this right now, we are in a situation where Indian valuation standards, though ICAI valuation standards have been issued, they are not notified as Indian valuation standards by the regulatory authorities. ICAI RVO has adopted the valuation standards which are issued by the VSB of the ICAI. So essentially, if you are a member of an ICAI RVO, then under the statute also, law requires that as the RVO has adopted a set of valuation standards, you will be following those valuation standards. So if you are a registered valuer and a member of ICAI RVO, then necessarily you have to follow ICAI valuation standards for valuation. However, if you are a member of any other RVO, which is very unlikely for the audience of this webinar, still for the larger interest, if there is a valuer, registered valuer, who is a member of some other RVO, and that RVO has not adopted any valuation standards, then my interaction with those value professionals, what I have understood is that they are following ICA valuation standards because they understand them to be the Indian valuation standards, plus they are easily accessible, plus there is a lot of literature around it for them to understand ICA valuation standards, and that's where they are also adopting ICI valuation standards, even though they are not a member of ICI RVO, or even if their RVO has not adopted ICI valuation standards. There comes a legal question as to whether uh, the statute requires those valuers to follow internationally accepted valuation standards, any other internationally accepted valuation standards. Now, the question is, ICI valuation standards, are they internationally accepted or not? And to this, if we were to understand the current context, at least India as a recognition of ICI valuation standards. There are certain neighboring countries also where ICI is putting in all the efforts to get the valuation standards adopted and recognized. And there have been various webinars in the past month also with a neighboring country where their value professionals, or the Institute of Chartered Accountants of Nepal, had also come up with those webinars, and they have educated their members in lines with the valuation standards of ICAI, which now kind of creates a scenario where you can also put that these ICI valuation standards are also internationally accepted. But that's food for thought on another day. The second requirement would be valuations for cross-border share transactions between resident and non-resident entities under FEMA. So if we were to look at FEMA and OI rules, and there's Rule 18 where the pricing for a transfer between this resident and non-resident is mentioned. And the language used there is arm's length pricing. And arm's length pricing determined as per any internationally accepted valuation methodology, and where they have not mentioned, the rules have not mentioned clearly as to whether standards have to be followed or only a methodology has to be followed. However, the wordings suggest that there is a methodology which has to be followed, which is a method under the standards, and that's where internationally accepted method is what is mentioned in the OI rules, and that would be what would typically be required to be followed when you are complying with, or when you are issuing a valuation report for FEMA purposes. Still, under that, if you follow ICI valuation standards, the methods that have been prescribed under the ICI valuation standards, they are internationally accepted methods. And that's where, even if you comply with ICI valuation standards, largely your compliance with FEMA OI regulations or rules would also be there. Then there is valuation under the Insolvency and Bankruptcy Code that largely has the premise of liquidation value. And that's where you have to be careful while applying the valuation standards and the necessary disclosures that are required for bringing those valuation standards compliance into picture. And the last would be income tax related valuations. Now, there are also certain cases where transfer pricing related valuations are required for certain intellectual property, all those other uh, crucial, or I would say complicated aspects of tax. But even under the normal aspects of tax, there's Rule 11 UA, which is a rule-based valuation. And largely it does not require certification, but still clients insist, everybody overall understands that there's a Rule 11 UA and compliance requirement is there. So when you do a rule based valuation, and that typically is not something which is covered by the valuation standards, because rule based valuation is a formula driven valuation. So there's just a simple formula and you're filling up the formula. So there you are not doing a role as a valuer, there you are doing a role as a, I would say, a computational guy or a normal accountant, where you would kind of comply with your other standards only and only where there is a formula based valuation, and not where there is any method prescribed, or DCF as a method or any other method which is prescribed. There you are necessarily governed by the valuation standards. Now, these we have discussed the end uses of the valuation standards. Now, let us come to the situation where whether valuation is an art or a science. Now, because we have discussed about a bit of standards, we have discussed a bit where, standards kind of come into picture for setting the context, for setting overall standardization. There's a minimum base that it sets. Everybody follows that base. Everybody follows a procedure, a process. The concepts are there, principles are there. So if it is so well written and documented, are we inching towards it being science, or is there an art element left in valuation? So it's kind of age old saying that you never have valuation as a pure science or a pure art. It's a perfect combination of both. But however, when you are using your valuation principles, if I were to give a very classic example, right? If there is a very famous bank, banking as a business is age old. Uh, there's no two thoughts about it that banking as a concept, as a business, there's not much of change in the fundamentals of how a bank operates. So if you were to value a bank, then wouldn't all banks have the same parameters? But still, why certain banks have a larger, premium on the market price or even the perception of value, right? There are banks which have been ranking on the trust list, trusted brands of the country for decades together now. And there are certain which are new age banks, and they still have better valuations than the longer serving banks. So typically, there is a lot more than what meets the eye when we look at valuation. However, the underlying genesis up to a certain level remains the same. So that's where, up to that level, up to the standards level, up to complying with all those requirements, you see a science in it. However, when you look at the current trends, the technology focus that the world has right now, if you were to value a normal tech company and an AI tech company, you would have a different perception to it altogether. Similarly, if you were to value a normal consulting company and a ESG focused consulting company, you would have a different, uh, knack to it, largely because today ESG is kind of something that is a buzzword and everybody is wanting to get into it. Similarly, was with a few years back, if you were to look at the electric vehicles valuation, today also they continue to command premium. But when at one time you understand that one company was valued more than three of the biggest, multi-decade existing companies, all of those put together were not at the same level at what Tesla was. So that's what is also necessary to understand, that there's always more than what meets the eye that needs to be considered while doing a valuation exercise. And obviously, the person performing the valuation, his experience, all of that comes into picture. So then now we come into the technical aspect of our discussion today, which is the Indian valuation standards issued by ICAI. We'll first discuss about the Indian valuation standards issued by ICAI. We'll then go into international valuation standards. We'll then go into the comparison. So if we were to look at the Indian valuation standards, which is the ICAI valuation standards, they were issued in June 2018. And obviously, chartered accountants are required to comply with it. Also, valuers registered or enrolled with ICAI RVO have to comply with it. So, what are the standards that have been issued by ICAI? The first thing is, if we are familiar with how laws or even any statute, as a matter of fact, has been implemented in India, Section 2 always starts with definition. The first is applicability, two is definition. Similar is the case with ICI valuation standards. They start with definitions. So those definitions are put at one place, and those definitions apply across the entire set of valuation standards. The second valuation standard that came was that was issued was means these are all issued together. This is just the sequence. The second one is valuation basis ICAI VS 102. So that provides for the base of valuation. 103, which is valuation approaches and methods. So this is one of the most technical valuation standard. So if we were to look at the practical aspect of valuation and how the entire practice of valuation would come into being, that would be through ICI VS 103, where you would understand what are the methods, what are the approaches, and when a particular approach has to be applied. So the entire practical aspect of valuation comes under IVS, ICI VS 103. Then 201, scope of work, analysis and evaluation. 202, reporting and documentation. 301, business valuation. 302, intangible assets. 303, financial instruments. So this is how the valuation standards have come into being. And this is a very structured approach for anyone to understand the valuation standards and kind of get a better knowledge on valuation standards. Then we come to international valuation standards. Now, international valuation standards are kind of, known as international valuation standards because they are issued by certain authorities or agencies or organizations that have an international presence and that kind of are recognized internationally. So what makes them international is just that they are accepted across more than one country, and that's how you would have an international valuation standards. And largely what it aims to achieve is consistency, transparency and confidence, kind of as we discussed, that as we move towards globalization, as the world is becoming one, you need some similarities, some level of comparison between the valuation standards across every jurisdiction, and that's where these international valuation standards come into picture. Now, if you were to understand international valuation standards in better detail, there are various organizations that are issuing valuation standards, right? Similar to what we discussed for the financial reporting standards across the world. There are so many financial reporting standards. Similar is for valuation standards. The various organizations that issue valuation standards include the Appraisal Foundation, the Royal Institute of Chartered Surveyors, the European Group of Valuers Association, and the most commonly understood IVS, which is the International Valuation Standards Council. Now, if we were to look at the nomenclature of this, when we look at IBSC, it kind of, the nomenclature itself suggests that these are international valuation standards, whereas all of these are international valuation standards. Still, largely in the Indian context, because all the other registered valuer organizations, as well as overall in the world, the most prevalent ones are the IBSC issued IBS, and that's where the concept of international valuation standards come into being. Now, today our discussion would focus only on IVSC issued IVS, which is the International Valuation Standards Council, and we are not going to be looking into the other valuation standards or the other international valuation standards. So the focus of our discussion today would limit to IVSC. Now, if we were to look at this IVSC, then there are more than 200 valuation organizations registered with IVSC. So essentially, IVSC is more like a non-governmental organization where everybody can become a participant, and there are certain requirements of IVSC where if a organization wants to become a part of IVSC, they need to have certain compliance requirements, which means that they have to work for the benefit of the valuation profession. They need to contribute to the growth of valuation as a profession in their respective country. And that's where even ICAI is a member of IVSC. And IVSC has issued the international valuation standards. Now, if the construct of the IVSC is that international valuation standards, which are issued by IVSC, they serve as the guiding light for all the member organizations. Now, within the IVSC framework, every member organization which works, so how does it work is that all member organizations are then free to issue region specific or country specific valuation standards. Now, if we look at our valuation standards, right, the ICI valuation standards, they have been issued independently. They are not issued under this authority, which means kind of this hierarchy. As ICI being a member of IVSC, ICI contributes as a global member, and they contribute to the growth of the international valuation standards. However, the ICI valuation standards are independently made. They are not carve-outs from IVS, and they are not something that are, modified version of IVS. They are separate versions, and that's where ICI-VS is completely separate, and IVS is completely separate. And there are various organizations which are registered with IVSC, which include the American Society of Appraisers, the Chartered Financial Analyst Institute, and ICI also as one of those listed on the website. So it has to be understood. This is a very crucial understanding that the valuation standards which are issued by ICAI, they are not carve-outs of IVS. They are separately created standards. They operate in a very separate fashion, and we'll look at the differences in the following slides. Now, the history of IVSC is also interesting, and the history of overall the profession of valuation is also interesting because earlier entire bulk of value was from tangible assets. In the past, the bulk of value was also from tangible assets, and the bulk of miscalculation or misreporting or misvaluations, if I were to say, were coming from that segment. So IVSC was first earlier known as the International Assets Valuation Standards Committee, and it was established in 1981, and the focus was on real estate valuation. And the committee had issued its first set of valuation standards in 1985. And since then, it has been working in the field of valuation. And the latest IVS is, which are effective now, have been issued on July 31, 2021. And there are a lot of changes that have been proposed to the IVS. Even last year, there's been a consultation paper around it. And in November of 2023, the IVSC had met and had also completed the changes. And they have mentioned that the IVS would be notified in the month of January 2024. Last I checked, they were not notified, and still we have the 31 July 21 version of the IVS as the issued IVS for global purposes. Now, IVS is classified into two segments. One are the general standards and one are the asset standards. So when we look at IVS, the construct is slightly different than what we looked at under ICI valuation standards. The general standards, they apply to all, which means that if you perform a valuation of inventory under IVS 230, then also that valuation would be guided by the general standards of IVS 101 to 105. So irrespective of which asset you are particularly valuing, each of those valuations would be governed by the general standards, which is IVS 101 to IVS 105. IVS 101 deals about the scope of work which a valuer has to agree. IVS 102 gives guidance about the investigations and compliance, which in ICI valuation standards has been named as documentation, which is compliance has been worded in that manner. Then there is 103, which is reporting, 104, which is the basis of value, and 105, which are valuation approaches and methods. And there are certain changes which have been recommended in November 2023, which we'll cover later on. And then there are asset standards, which essentially cover business and business interests as an asset category, which covers intangible assets, non-financial liabilities, inventory, plant and equipment, real property interests, development property, and financial instruments. So those are the asset specific standards as to when you are valuing those particular assets, what valuation standards you would follow. From that, as you kind of glanced through the international valuation standards which were presented in the earlier slide, we would understand that the asset classes were broadly more than what we, as the audience of this webinar, would be concerned with. And that's where it is important to understand the asset classification in India. In India, we classify registered valuer profession between land and building, securities and financial assets, and plant and machinery. So today our discussion and our entire focus of discussing, valuation standards is from the securities and financial assets point of view. We are not going to be discussing anything about the other aspects or any other asset classes, which is land and building or plant and machinery. We leave that for a different day. We are focusing today on securities and financial assets, which would typically include businesses and business interests, shares, securities, non-financial liabilities, intangible assets, and inventory. Now, because inventory doesn't fall into any of the other two categories, they fall under securities and financial assets, and that's where the one more added information we need to be aware of. Now, this is a brief comparison of ICI, VS, and IVS, where we are comparing what are the existing standards under the ICAI valuation standard versus IVS. As we already discussed, definitions is something which is very specific to ICAI valuation standards because that's how the Indian statutes are designed. The overall consistency that ICAI has brought into the definition of the standard is because they've put definitions at the very beginning, which is a common feature for all. Whereas the IVS puts definitions into the respective standards, that if there are particular words which are used in a particular standard, they would put the definition there, and that's how they have structured the valuation standard. It's just a structural difference that the definitions in ICI valuation standards are separately in a 101, whereas in IVS there's no separate standard for definition, and they are put under respective standards. The second standard, as per ICI valuation standard, is the valuation basis, which is also 104 as per IVS, which is basis of value. They kind of describe the nature of valuation based on the subject asset to assist in identifying the method or approach of valuation. So, base of valuation is typically the guiding light in which you would select the approach or method, and that base of valuation is very important for you to decide on the on the approach and method that you would consider. There's not much difference between ICI, VS, and IVS so long as basis of value is concerned. Under ICI valuation standard, valuation approaches and methods are there. And similarly, under IVS 105, valuation approaches and methods are there. And there are various methods which have been issued by organizations, which are explained in the next slide. We'll also compare this standard in much detail because typically this is the most practical standard of knowing how valuation would kind of be different under a ICI, VS, or a IVS. 201 in ICI VS is scope of work analysis and evaluation, whereas in IVS 101 only deals with scope of work. So they only have the specifying the terms of engagement, general requirements. So all of those are covered under the scope of work of IVS, whereas ICI VS does not only include scope of work, but it also includes analysis and evaluation. Analysis and evaluation of 201 ICIVS is very similar to IVS 103, which is investigations and compliance. So if we look at investigations, the word that IVS uses, that's more like analysis and evaluation under ICIVS 201. And that's because IVS has used investigation as a grammatical term in its normal English language, that a valuer, how much should a valuer investigate? Whereas we being chartered accountants, we have a very different, approach or meaning assigned to the term investigation. So if we look at it as audit professionals, investigation becomes much more wider in scope. And that's where ICI was very careful in choosing the word, that in India, if we use the word investigation, it would kind of broad base the entire concept, whereas what we want to actually use is analysis and evaluation. So all of these carve outs make our ICI VS very Indianized and very easy to understand. Plus, there's not much to deliberate on this, that what does it intend to convey, because of the familiarity of the terminologies used in the valuation standards. Similarly, under 202 ICIVS, we have reporting and documentation, whereas comparing it that with IVS 103, it's reporting and compliance, which is similar, but then investigation as is comparable to 201. 301 in ICIVS is business valuation and 200 is business and business interests. And then there's financial instruments, which are again financial instruments. So this essentially covers the brief comparison of the standards that are available across ICIVS and IVS. And that is where the difference is, as we discussed, not much of a difference, it's just structural difference, slightly here and there, and some things which are separately put as definitions in ICIVS are not there in IVS. They are included in each of the standards, and some about the changed terminologies where investigations, evaluation, those things are there, and some of the restructuring which is more in context of how Indian valuer would approach this, and that's how ICIVS are more customized to meet the Indian requirements. Then, if we were to look at the other standards which are not there in ICIVS but there in IVS, one is non-financial liabilities. So, non-financial liabilities would typically mean, certain uh, complex assets or complex liabilities that need to be measured for various purposes. For example, a warranty claim. If there's a warranty liability that needs to be measured, then how would a valuer go around measuring it or valuing it, or a contract liability, which are some non-financial per se in nature at present, but there has to be a financial outgo attached to it. So how would you value a non-financial liability? That guidance is there in IVS, which is not there in ICIVS. Then inventory valuation. So IVS has a special or a specific standard governing inventory valuation, whereas ICIVS does not have that. And inventory valuation can be in India for the context of IBC and as a specific separate item. Then there is plant and equipment. That's also specific to other asset classes. Real property interests, which also are with land and buildings. So that's other asset class. And then there's development property, which also is through something like redevelopment or any other real estate item. So typically that also stays outside our discussion purposes. Now, the next three slides essentially cover what is the difference between ICI valuation standards and international valuation standards, and how ICI valuation standards have Indianized the approach, and how international valuation standards are commonly applicable across the world. So, what's the difference? And we as chartered accountants would easily accept and understand, ICI valuation standards, and that would kind of be very familiar to us. Which one is the first thing if we understand that when we agree the scope of work, valuation standards internationally do not require it to be in writing. So essentially, what IVS says is that you have to agree to the scope of work. It does not say it has to be in writing, whereas ICI valuation standards require it to be in writing. Then, if there are any changes to scope of work, that also IVS does not require it to be in writing, whereas ICI valuation standards require that change also to be in writing, which is kind of even professional in approach. And when we are dealing with chartered accountants as a service provider, as a part of the entire ecosystem, we understand that having things in writing are so much more essential. And that's where ICI evaluation standards has considered that and also implemented that as a part of the standards. Then, what about disagreements? ICI evaluation standards is specifically put in context that, if the valuer is unable to agree to any terms of engagement and or is not permitted to continue as per the original terms, the valuer may withdraw from an engagement and need not report it to the client if there is no obligation, contractual or otherwise. However, there is nothing about disagreements mentioned in the IVS. So, if under an engagement, a valuer has accepted an engagement and the scope of work changes, or they are not able to kind of get information as was originally planned, ICAI clearly gives a mandate that okay, the valuer can withdraw from an engagement. They may withdraw depending on what limitations are there, and that may be communicated to the client in writing or otherwise, which may be a contractual obligation or not. So that's a clarity that's given on handling disagreements. Whereas under the IVS, that clarity is not coming. So what would happen on the case of a disagreement is open to the parties, and as the scope of work has not been agreed in writing, if at all there's a written agreement for valuation, that would prevail. Otherwise, the general law of contract would prevail for that, kind of a disagreement. Then in the ICI valuation standards, fees for valuation is a mandatory element to be mentioned in the engagement letter. Plus, the valuation standard also says that under the code of ethics of valuers, we are not allowed to take any ad valorem valuation fees. So that all disclosures come under the ICIVS, whereas that is not a part of the IVS. Similarly, ICIVS is silent about the currency. If we were to value any asset under the international valuation standards, they would have a requirement of currency being mentioned, because ICI international valuation standards prescribes for the requirement to mention currency, whereas ICIVS does not mention about currency. The underlying concept here is that any value without a currency is meaningless, and normally it wouldn't be so relevant for it to be mentioned, because in the standards, because in the report every valuer is going to mention the currency. It doesn't uh, happen without mentioning the currency. Whereas the IBS is specific about valuation currency largely because of its applicability as a overall, more countries globally. So they considered it specifically necessary to mention about those valuation currencies. The second thing that I understand is that when you value any group which operates across the world, say a company having say 30 subsidiaries across the world, and if you are to value the entire list of subsidiaries, then it becomes very essential for you to mention currency, because each of those countries and each of those companies would operate in jurisdictions with separate currencies. So there, it would become utmost necessary. Also, even in the normal report, it becomes necessary, because without that, it is not much relevant. So that currency is one difference that ICI valuation doesn't put as a separate mention. That it's more logical. And ICI valuation standard does not mention assumptions in the scope of work, but any significant or special assumption that the valuer makes or that would change the valuation, they must be mentioned in the valuation report. So that is something that ICI valuation standards requires, whereas the international valuation standard requires all the significant and special assumptions to be made in the report. The second key difference is the limitation on investigation or analysis. Now, if we were to look at ICI valuation standards and chartered accountants per se in general, plus the standard setting across for chartered accountants, plus the stakeholder expectations, the society expectations, we look at an Indian context where it is very highly expected from all professionals to be very meticulous about their profession, to be very, deep diving into whatever they do. And that's what the general societal expectation comes into being. Whereas the professional standards have a materiality threshold, have all those other considerations for practicality aspect of it. However, the ICI valuation standards have not placed any limitation for investigation by the valuer. So analysis and evaluation, the words that are used in ICI valuation standard, they necessarily require the valuer to be reasonably comfortable with what is being a part of the entire valuation exercise. And that is where there is no specific arrangement within the valuation standards that kind of limit the analysis or examination that a valuer may perform on a valuation assignment. So if we were to look at international valuation standards, they give a limit which may be prescribed. Now, here where the overall discussion lies is between compliance valuation and advisory valuation. If we were to look at a compliance valuation, where, any third party or a stakeholder is involved, if there is any public involved, if there is any financial institution involved, or if there is even a specific need for a valuation which arises on the happening of an event or certain requirement of valuation, then obviously all those standards and all of those principles have to come into picture, and uh, all of the requirements of valuation standards should be complied with. However, there are situations when, a client may come to a valuer and just want to sit and understand how to create value in the business. It's kind of value consulting, and they would want a frank or a candid discussion on where they are doing right, what they are doing wrong, and how, in the opinion of a experienced valuation professional, would their existing business create more value. So at that time, the valuer plays an advisory or a consulting role, and they are not much into any of those standard driven uh, set. So their international valuation standards create a carve out that, a valuer can, under a scope of agreement with the valued entity, enter into a scope limitation that they would not be having any investigation or any other analysis of the information provided done, but they would only be providing guidance valuation, and that would kind of be, relying on what they provide to the valuer, and they would give their opinion and value advice on it. And that's something that's given in international valuation standards as a limit that can be agreed between the parties. The same is not mentioned in the ICI valuation standards. That being said, if it is advisory or consulting in nature, where, you're not performing any valuation analysis, but you are kind of giving your views on what the value drivers of a particular business are, or how a business can create value for the long run, then that would kind of be in a zone where it is okay for the valuer to give that views and opinions. But if we are giving it in writing, and again that kind of complicates things, because then whether what you are issuing is a valuation analysis or a valuation report or not, and whether you have to comply with ICA valuation standards or not, becomes a gray area. So that is one difference between ICI valuation and international valuation standards. That's kind of slightly, having a far-reaching impact if we were to say in advisory and consulting roles. Then ICI and valuation standards have a subsequent event requirement, which is not found in the international valuation standards. So here it's something that our, genes of a chartered accountant come into picture while we are performing a valuation role. That if we understand valuation, there's a valuation date, then there's a report date, and largely what happens is that it's very rare for a report date and the valuation date to be the same, because there's a lot of analysis that goes into valuation, and there's also some kind of data preparatory work that even from the business side has to happen. From the client side, they have that time gap for just preparing that information. So the valuation date is, say, if we were to value today, it might be 31st of December 2023. And the report date would become the 21st of January. And that entire thing brings a gap of 21 days between the valuation date and the report date. And that is the period where subsequent events are something which a valuer may have to consider. Whereas in international valuation, there are no provision for considering subsequent events. So that is something which is, kind of a digression between the ICIVS and the IVS. Now, if we look at the overall understanding of how valuation works, it's more like a blood report. If you were to take a blood sample yesterday and there's an investigation on it and there's a finding, it is not necessary, even though it is very more likely that if the blood taken today would have the same characteristics, but not 100%, right? If it's a trace of a particular substance in the blood at that time, it may not be here, but the overall larger genetic characteristics would remain the same, or the larger characteristic would remain the same. So that's where subsequent events, whether that's a part of ICIVS but not a part of IVS. Then under the IVS, the valuer should consider the events that could affect its valuation and assumptions, and also such facts have to be explicitly disclosed in the valuation report. So this is something which is specific to IVS, but that kind of is also covered under the earlier paragraph where we discussed that scope needs to be, any of the deviations from scope have to be presented by even the ICI valuation standards. Reporting. So again, under the ICI valuation standard, there is no specific format of a valuation report. However, there are certain disclosures that need to be done as per ICI VS 103, and those does not necessarily require a specific format. It is more about what needs to go into the valuation report, what is something that would kind of form part of your valuation report. That is all given as disclosures. Now, where exactly to disclose, how exactly to disclose, and what is the sequence of those disclosures are something that are not given in the ICI valuation standards. However, under the IVS, there is a predefined format of valuation report, and that kind of can be considered by the valuer for, and on the basis of the report that they are issuing and for the purpose of valuation that they are carrying. Under the ICIVS, there are 8 elements of valuation report which have been specified, and under the IVS, there are 13 elements of valuation report. Largely, it's more of clubbing in ICIVS and segregation in IVS, but the content and the overall, scheme of it remains the same. Under ICI valuation standards, a valuer may obtain written representation from the management regarding information for performing the valuation assignment. So typically, again, our chartered accounting side came a bit into the valuation side, and that written representation letter is something that is mentioned in the ICIVS but does not find a mention in the IVS. Now, it's a good practice to have this, and that's where it's more in the, uh, I would say, progressive side of it, that it sets good standards and it's kind of gives a better level of uniformity in approaching valuations. And even for management, when they kind of give valuation numbers which are not in line with their business plans, once you ask them to kind of, sign off on the numbers that they have provided, they kind of think twice before it is just put as a number in the model. Documentation. ICI evaluation standard prescribes that the reports and working papers should be maintained for at least 8 years, whereas the same is not mentioned in IVS. And there is a list containing minimum 8 documents to be maintained under ICIVS, which is not there in the IVS. So that's something on the documentation part of it that ICIVS focuses on. And again, that's a good practice if uh, that. So again, as we discuss, right, the standards are the base minimum that you should set. So even if we were to follow IVS documentation, the number of years for which it will be maintained, that would be built upon the IVS by the professionals. Now, ICIVS sets those standards a bit high, that this is the base which include you to maintain documents for 8 years, which include you to have at least these many documents for each valuation assignment, and that kind of is a standard setting which is slightly higher than what the international valuation standards are there. And I think all of this is progressive and kind of brings into a feeling of professionalism in approaching valuation. And that's where all of these different approaches come to all of these different requirements come into being beneficial for the professionals following ICI valuation standards. Now, the interesting discussion about comparing the valuation methods and approaches, because that's the most practical aspect of it. Now, the approaches, right? Globally, there are three approaches to valuation, and those are market, income, and cost. So, even under the ICIVS or under the sorry, yeah, even under the ICIVS and under the IVS, both of these follow the same uh, approaches, which is the market approach, income approach, and the cost approach. Now, there are various methods which have been described in the valuation standards across ICIVS and IVS. If we were to look at the market approach, the second and the third method prescribed in the ICI valuation standard remains the same, which is the comparable companies multiple method and the comparable transaction multiple method, which under IVS is named as comparable transactions method, which is under the ICIVS comparable transaction method, and guideline publicly traded comparable method, which is the comparable companies multiple method. So largely these are the same. They kind of do not have any significant difference between them. The only separate method which is mentioned in the ICI valuation standards is the market price method. Now, this is something that kind of is a logical conclusion for the Indian context also, that if I were to say exchange a listed company shares with you, for example, say you hold HDFC Bank shares and I were to trade those shares with you. Largely, your understanding of the value of HDFC Bank shares, if we were to transact today, would be derived from what the market price of that share is. If there has been a sudden change in the price of the share right now, which is the case with the particular security that we discussed, HDFC Bank, then largely the idea would be that if we were to look at the volume weighted average price of the last 6 months, that would be a fair estimate of how HDFC Bank shares would change hands if me and you were to transact. So that's where market price method comes, that if an entity is listed, then the listed price factors everything. And that's where the market price method is mentioned in the ICI valuation standard, but does not find a mention in the IVS. Under the income approach methods, though the most commonly used method is discounted cash flow method, and that is common across the ICI valuation standards and the IVS. In ICI valuation standards, there are various other methods which are mentioned for valuing particular asset classes, and those are mentioned, with a specific guidance as to when which method has to be applied. So, if we look at relief from royalty method, that also is a assumption and a carve out of the DCF. So, if we were to look at relief from royalty, what does the method say? Is that the assumption that goes, if a particular company owns a trademark and that trademark, had it not owned and had somebody else owned it, then what would the royalty it would have paid to that trademark owner? So the method populates the royalty across the future years, which is a notional royalty, and then they calculate the entire benefit that accrues to that specific royalty item, and it is considered to be a relief from royalty, that as the business is owning this trademark, it is not required to pay this royalty, and that's how the value of that trademark would be derived from. Essentially, it is, if we were to put it in normal terms, it's a DCF of the trademark owner. That had the trademark owner just got these cash flows, what would be the DCF of that trademark owner's cash flows be, and that's the value of the brand. And that's how relief from royalty method, again, a carve out from the discounted cash flow. Multi-period excess earnings method, again, the same thing, with slight tweak of a DCF model, the with and without model, comparing both, finding value and getting the difference to that particular asset. So all of these methods are somewhat carve outs of the DCF model, and that's where the valuation standards internationally do not have much more guidance on those individual methods specifically, but they discuss the general method of DCF. Whereas the ICI valuation standard kind of brings in all those methods and explains where which method has to be applied. And that's kind of giving more clarity rather than, I would say, having a difference in the two. The income approach under the ICI valuation standard also covers a bit, very small part of it, but a very just an introduction to the option pricing models, and it lists out Black-Scholes method and the binomial model for option pricing as a model, and that's how the ICI valuation finds a mention about it. But again, applying Black-Scholes or binomial is something that a valuer has to learn, because the valuation standards just provide it as a base. They then the valuer has to build on top of it. Then there are cost approach methods, where replacement and reproduction cost method both are common across ICI, VS and IVS. However, the IVS has a summation method, and that's kind of just having the same thing but split across to the sum of individual items has to be done instead of a consolidated approach. So these are the larger differences in approaches and methods. With this, we'll come to the penultimate slide, which is about the key developments in the international space. As we discussed, right, that in November of 2023, various changes to the international valuation standards have been adopted, and concluded that they would be changed to that extent. And the overall idea about it is to bring in regularly, update changes, put them into context. So we'll just discuss the latest developments in the international valuation standard space, where IVS 100 is proposed to be introduced, and that is more like the framework that is there in the ICI valuation standards. Now, even internationally, they want to introduce a preamble as to, when which standard is mandatory, when is what applicable, how to read the standards, whether the general standards, etc., are completely. So all of those things which were, kind of not written or explicit, they are putting it in the form of a framework. Scope of work, no major changes. Investigations and compliance. Now, what they've made applicable is that instead of a standard investigation and compliance standard, which is like blanket standard across all valuations, they have now put investigation and compliance also specific to each standard. So just like definitions which apply to each standard, they have gone even for investigation and compliance, which would be removed from the general standard and uh, put into every standard as their specific requirement. The basis of value do not change much. The valuation approaches and methods. So now what they have done going forward is that as IVS 103, they are now only putting valuation approaches and separating valuation methods and models into IVS 105. So 105 erstwhile will be split into 103 and 105, and those models would then move into IVS 105. Data and inputs. So they have now started issuing a separate standard for using factual data and information for valuation, and uses of special organization and its related documentation. So that is what is a change that is coming into from it was mentioned about January 24. So that's why we thought it would be interesting for everyone to know. And reporting now moves into documentation and reporting. So if we were to look at the changes that are being proposed to IVS, it is more from the ICI VS that is going into IVS, that there were no specific standard for documentation. Now it has been included along with reporting standard. and documenting comprehensive things required for such valuation. Then into the other asset standards, there are IVS plant and equipment, which was there. Now they are moving into plant equipment and infrastructure. So infrastructure has also been included as a part of this standard, and largely they are specialized or a network of assets which are otherwise earlier specified under 400 and 410 of IVS, but if they don't find a specific mention there, then this is where they would kind of be guided with under IVS 300. So internationally, if we look at the entire developments that are happening, we would see that as we discussed ICI valuation standards and international valuation standards, we'll see that ICI valuation standards has already set the bar a bit high, like putting documentation in place, putting all those other things already into place in the first cut or the first draft of the valuation standards. And just like any other standards, there would obviously be evolving nature of the valuation standards also. However, it is heartening to know that a lot of the changes that were originally there in ICI valuation standards, a lot of features that were there, they which we discussed as differences between ICI, VS and IVS have now started becoming a part of IVS, which essentially kind of brings our confidence up about ICI, VS already setting the standard a bit high. So, and as we discussed, right, standards are the starting point and you build on top of it. So when your building starting point is itself high, then you are already at a better quality of services and professional approach towards your assignments. And that is something that would bring us also, more confidence in approaching valuations, bringing in consistency, transparency, and also uniformity in how we as valuation professionals would take the valuation profession forward. And I think this was what I had planned for discussing today. And for questions and answers and stuff, I would leave some time. So I think with this, I can bring the questions and answers to the fore.
Thank you so much, sir. It was an enriching sessions. It was an enriching session, and there are a lot of questions. So the first question being, RBI seeks valuation to be compliant with international accounting standards. ICAI members are bound by ICAI valuation standards. Banks insist on mentioning that valuation is compliant with international standards. Kindly guide on how to proceed.
Yes. So if we were to, kind of understand the requirement under the FEMA overseas investment rules or under the other FEMA applicable standards, right? The first thing is the new regulations, which is the OI, which is 2022. They have come with the wordings which are arm's length price. So first is arm's length price. Second, which is certified by a chartered accountant and using internationally accepted method. So here the requirement of the regulations. Now we'll come to practice versus law, right? Law says that you need to have a internationally accepted valuation methodology. So if we were to look at the valuation standards, methodology is the same, right? Just as we compared approaches and methods, DCF remains DCF. Now, again, internationally accepted DCF, yes, even if you perform a valuation using DCF under ICI valuation standards, it is internationally accepted methodology. Now comes the question of practice. Now, even though law just requires methodology, what happens in real life is that bankers, AD banks come up with a requirement of putting, you know, the wordings of you using international valuation standards, whereas the law does not require that. So I think a lot of it is a part of educating the AD bank also, because not all of it comes from the central compliance team. It comes from the local branch and they have their own checklist. And last time, how it was processed, we should have the same checklist issued to every person coming along for FEMA matters. So that's where one, I would say the first attempt for us should be to educate the AD bank also that, it's more about the internationally accepted valuation methodology and not valuation standards. Plus, as I discussed, right, last month there has been a good effort from ICAI to have the valuation standards issued by ICAI even in ICANN. So, if even that goes forward, then ICAI valuation standards would become international valuation standards, and that's how you could possibly even solve that problem, even if there's a insistence from the AD banks for international valuation standards. But even to add a bit, right? Even if today you can in your report you perform your report as per ICI valuation standards and you put a note that you know though we have complied with ICI valuation standards, the differences between ICI valuation standards and international valuation standards issued by ICA IVSC are not material to affect the findings or conclusions of this report. And I think that's a middle way. If the AD bank is not getting convinced, you can put that. But your professional requirement is to comply with ICI valuation standards, and then you can put a note or an addendum to the report saying that even had this been prepared as per internationally IVS, there wouldn't have been any material differences in the findings of value.
Thank you so much. Moving forward, can CA do valuation or do we need any additional certificate for doing such valuations? And also, is UDIN required for valuation reports?
Yeah, so there's clarity around this that for valuation reports, UDIN is required, and even ICI RVO insists that, as a member of a ICI RVO, you need to issue the UDIN based on that report. So that UDIN part is very clear. Valuation per se, see, I'll give you my views to it, right? One is Rule 11 UA, and I think that's the most common valuation that most of the chartered accountants would face. That there's a share transfer or a issue of shares happening, and then there's a valuation requirement. Now, for issue of shares under 56 to 7B, chartered accountants are kept out. So we are not eligible for issuing valuation reports. For Rule 11 UA, there is no requirement of obtaining a valuation report. If we were to look at transfer of shares, the formula driven method A plus B plus C plus D, that method does not require anywhere a valuation report to be obtained. Still, clients prefer to obtain or chartered accountants prefer to provide. Now, that's a separate thing. Under regulation, right? SEBI has now required valuation reports to be issued by, and even under Companies Act, it's a mandatory requirement to issue a valuation report by registered valuer. Under FEMA, at certain places, it's a chartered accountant, and beyond a certain price, it's a merchant banker. So, apart from where chartered accountants are now permitted to issue valuation reports, most of the places registered valuer has come into picture, and going forward, also registered valuer would take more prominence because it's a separate profession that has been, in the making. So, in the long term, you would definitely need to be a registered valuer to practice valuation. And in the current scenario, there are certain parts of it only that remain to a chartered accountant, whereas most of it has already gone to the registered valuer.
Thank you so much. Moving forward, how business synergy effect after merger can be predicted? Most of the valuation miss the estimate.
So I would say that see synergy in the future is there, right? But that cannot be the base of your value. Synergistic valuation, it's more into advisory nature that whether you should merge or not, and you can estimate synergy. I would say there is no requirement per se to estimate synergy. It's more about a commercial nature of synergy and advisory part of valuation, because the base of valuation is clear when you define it, right? When you define your valuation report, it's on the base of value that you define. And that's where I would say that most of it miss synergy because synergy is something which cannot be predicted. Like I would give an example if, when WhatsApp and Facebook merged, or when Facebook acquired WhatsApp, everybody thought it was an overpriced valuation, like even including the industry stalwarts. But then the synergy was only predicted by the acquirer. I would put it in that way, that at that time there was no one who would have said that this is just overpriced. But at today's scenario, I think that acquisition would have brought more value to the overall organization, Facebook, than anything else. And that's where synergy prediction is something which is commercial in nature, then more into putting it into numbers and putting it as a value.
Thank you so much. Moving forward, does Income Tax Act recognize registered valuers too, or just merchant bankers?
No, right now it is only merchant bankers.
Moving forward, are there specific competencies or qualifications required under Indian valuation standards that may not be emphasized on in IVS?
So there are no qualifications per se under any standards to the best of my knowledge. It's more about the regulatory part of it. So under the Indian context, IBBI is the authority which has been given the responsibility to regulate valuation as a profession, and they have set the standards that you need to be a graduate with so much of experience, and this is all your qualifications that you need to get enrolled as a registered valuer. But that is about it. The valuation standards per se do not have technical qualification requirement either in India or globally, because regulators per se would regulate that profession in that manner and give those qualifications. And that's what I know. I haven't done any research on this, but yeah.
Okay, thank you, sir. Moving forward, are there specific industries or types of assets for which Indian valuation standards provide additional guidance compared to international valuation standards?
So I would say there are certain assets where additional guidance is provided, just as we discussed, like options, right? Option pricing models, black scholes or binomial that they have mentioned. Plus, the ICI valuation standard gives good guidance on valuing intangible assets, which is that, for example, if the brand has to be valued, then which method to apply, that level of if I were to say spoon feeding has been done in the valuation standards, that the most appropriate method would be this, but still it's not a written law, so you can possibly have a different approach or a method to it. But largely, what would apply would be the relief from royalty when you are valuing trademark, or that's how some guidance across all these asset classes are provided in Indian valuation standards, which is more than the IVS.
Moving forward, this is with reference to slide 22.
Yeah.
In absence of any specific standards in ICAI valuation standards for the items mentioned in slide 22, then how these items are addressed in ICAI valuation standards and how these items are to be valued under ICAI valuation standards.
So largely, I would say let's take the example of inventory, right? If we were to value inventory, then we unfortunately wear two hats, and that two hats are one as a chartered accountant and one as a registered valuer. So if there is no guidance given under the valuation standards for valuing inventory, you would first be guided by the overall general valuation standards that are applicable, which would say that you need to have either an income approach or a market approach to valuing these standards. The second hat you immediately wear is that of a chartered accountant, which means that you are governed by, for knowledge, that there is AS2, and then there's lower of cost or NRV, whichever is, kind of available, and the selling costs need to go away. So automatically your brain starts thinking in that direction, that if I were to value inventory, I also need to consider the accounting value which is required to be disclosed in valuing inventories. My view here is that when you are valuing inventory, you would not essentially value at lower of cost or NRV. This is because that is an accounting value, and that's for a specific purpose, which is financial reporting. Whereas when you are looking at value for a particular end use, right? Example, liquidation value. So you have defined your base of value. So whatever follows under that base of value, under the valuation standards, that needs to be followed for the purpose of valuing those assets depending on the end use, right? If your end use is financial reporting and you value inventory at market value, then even your auditor, the auditor of that entity will not accept it because accounting value would be very different. So in that context, I would say that you'll have to look at the end use of your valuation and be guided by the overall principles, the general standards which are provided in the ICAI valuation standards.
Thank you. Moving forward, does the valuation report comes under assurance assignment
Yes.
and gets covered under peer review mandate of ICAI?
So, as you are a member of, so there are two things. One is that this is not an attest function, this is not an assurance function, and that is there. The second thing is about peer review. Peer review, so if you are a member of ICI RVO, right, then there's a peer review mechanism for ICI RVO, which is to ensure that you are complying with ICI valuation standards and to kind of be in a good quality standard, and that's where the peer review of ICI RVO comes into picture, but that is at present selective in nature, and that is uh, to the best of my knowledge happening under the requirements of the charter of ICI RVO along with the insistence of IBBI, but ICAI peer review would largely not cover valuation engagements. But as a overall assignment, when you are signing in the capacity of a chartered accountant and not a registered valuer, those assignments are covered as advisory assignments or assignments per se for uh, other attest functions and not assurance function, because necessarily you need to issue a UDIN. So there's a dilemma between this, that this would whether be a attest function or non-attest function. But as you have to issue UDIN, it is there. But to my mind, it is not an assurance function because there's no standards on auditing that you are following, nor are you following the uh, guidance note on certificates or special reports. So it's in my view not a assurance function.
So moving forward, if in unlisted Indian company, foreign shareholder is holding 25% and they want to exit based on the pre-agreed price at the time of investment, then whether current market value of the company, DCF valuation, asset valuation, or pre-agreed valuation will prevail. What if DCF or asset valuation is less than pre-agreed value?
So I would say that, see, pre-priced agreements are not permitted under FEMA. So largely, it's something that a foreigner cannot enter India with a guaranteed exit price. And if that guaranteed exit price is more than the fair market value, you need to go to RBI for approval. It's not permitted otherwise. That being said, FEMA regulations are very clear. So FDI, if it is there, the transfer of FDI has to happen in compliance with pricing guidelines. Anything not in compliance with pricing guidelines has to go to RBI. So if your agreement itself is that the investor invested at say 100 rupees and the exit price is fixed at 400, but the fair market value is only 200, then transaction can only happen under automatic route at 200. If you have to do the transaction at 400, you need to go to the RBI.
Thank you so much, sir, for sharing your knowledge and wisdom with us. There are a lot of questions which are pending, but due to paucity of time, we will have to end our session here. So, as we end, I thank you on behalf of ICAI. And thank you so much for taking out your valuable time and sharing valuable insights with us. We also express our gratitude to our chairman and our vice chairperson and the entire support team of ICAI for initiating and supporting this platform for the field of valuation and guiding us. And also, we acknowledge the effort of our audience for their active participation, for engaging your time and for being on this journey of valuation expertise. We are eager to meet you all again in the upcoming sessions. Thank you so much. Thank you and have a great day.